Thank you, Chairman. Dr. English, in your testimony, you said that Dodd-Frank and CARES Act requires the Secretary of the Treasury to approve the Federal Reserve emergency lending operations and provide oversight over the Fed credit allocation. In an effort to reduce the red tape and safeguard the Fed from making bad political decisions, wouldn't it make more sense to just have Treasury provide emergency lending instead of the Federal Reserve?
Congressman, I think that would not be as effective. The Federal Reserve has considerable information about the economy, about financial markets and financial institutions, so it can understand better, faster, what may be going wrong in the economy or in markets. It also has a great deal of experience in doing market operations and in lending because of its responsibility for the discount window, so it can ramp up and take action very quickly. And when necessary, it can also lend by creating reserves to lend, and that can be a very valuable thing to do at times when markets are disrupted and it may be slower for the Treasury to raise money to do that. And the increase in reserves can also just be a benefit in a time when there's every demand for liquidity. So I think these are responsibilities that are lodged with the Fed for a good reason, and that's why most central banks, I think, have authorities along these lines.
Very good, thank you. Any of the other panelists have a thought on that? Yes, sir, Mr. Lacker.
Yes, I've given this some thought over the years. I think that the lodging discretionary emergency lending authority with the Fed has had some benefits at times, but it's had a tremendous cost as well. Over the course of the last 50 years, since the mid-60s, repeated instances of lending to failing institutions and letting uninsured claimants get their money out has tilted the incentives of our financial markets and made them much more fragile than they otherwise would be. It's induced a dependence on short-term funding in wholesale markets, which is exactly the kind of funding that Fed interventions are designed to relieve pressure from. And I think that has to be reckoned on the tally sheet of assigning emergency lending authority to a discretionary body as technocratically capable as it might be. I think also that the pandemic experience showed that Congress is capable of enacting emergency legislation on a short time frame if the need is urgent enough and there's the political will.
So, Dr.
May I give you one quick answer?
Yes,
that
sir.
is,
go ahead.
I can't tell you, sir, how many times I've heard the Fed has to do this because they're the only game in town, or they're not the only game in town. The Congress is here and giving credit to non-banking institutions. Even an emergency can be handled, I think, very effectively by Congress.
I appreciate your confidence in the Congress. Let me just continue with that, Dr. Lacker. So you testified that Treasury, instead of the Fed, could just as easily have facilitated any lending programs. So if there was a crisis in the future, would it be prudent for a new accord to reassign those responsibilities away from the Federal Reserve and delegate those to Treasury, or do you think that wouldn't make much difference? A decision would have to be made in the moment.
So there's a less extreme approach to shutting the Fed off entirely, but one which would, in an accord, establish the principle that the Fed, after a certain number of days, say 5 or 10, a short number of days, transfers the position to the Treasury, the books of the Treasury, in exchange for short-term Treasury bills. So the Fed could do that lending subject to the approval of the Secretary of the Treasury, but get it off its books and have it managed by the Treasury.
So would placing emergency lending programs like those set up during the financial crisis and the pandemic that were set up in Treasury instead of the Fed, is there a negative impact associated with that, or some type of market instability caused by that?
No, I don't think there's consequences for financial market stability. If anything, they'd be beneficial in, encouraging private market participants to be more careful stewards of their own risk.
Gentleman's
The
time has
one,
expired.
okay.